Hello, everybody, and good afternoon, and welcome to the European Road Freight Rate Benchmark for Q3 2024, brought to you by TI, Apply, and IRU. We're very pleased to welcome you to the latest edition of the webinar, and we'll just wait a few moments for the rest of the participants to join, and once we've got most people, we'll get going. So please bear with us. Okay, it looks as if participant numbers are fairly stable now, so we'll get started. So hello again, everyone, and welcome to the TI Apply and IRU European Road Freight Benchmark for Q3 2024. We're very pleased to have you on board with us again to discuss everything going on in the road freight market, rate developments and the outlook, as well as some of the big changes we're seeing going on in the market behind the scenes around tolling, tachographs, and fuel developments as well, which we'll be discussing. I think since the last webinar, we've seen not all too much change really in the market. Freight rates have in fact remained relatively stable, at least compared to the last few years, and we're still waiting for that European recovery to really kick in, though economic conditions are improving. And with costs still elevated, the rate picture is fairly similar. But we're going to be talking through all the changes today. As usual, we'll have about a 35-minute session followed by a Q&A session. So please do feel free to ask any questions you have throughout the course of the webinar using the Q&A app. The team behind the scenes here will try and answer as many questions as they can in writing while the webinar is going on. And we'll deal with as many as we can at the end of the session, but we'll also be able to be in contact to answer any outstanding questions after the session today as well. You'll also all be sent a copy of the report and the recording of the session as well, should you want to view it again or share with any colleagues as well. So rest assured, those will be sent through after the session. And the only other thing to mention in terms of housekeeping is that we will be running a poll during the webinar, so please wait for that. We'll do that on the first European level benchmark pricing section, so you can give your own views as to how you expect rates to develop in the upcoming quarter as well. Okay, so we'll move on to introducing the panelists now. So I am Michael Clover. I'm TI's Head of Commercial Development, and I'll be your host for today's session. For those of you that don't know Transport Intelligence, we're a market research company providing strategic intelligence for the road freight industry in Europe and indeed the global logistics industry. So if you have any questions about the future of the market and strategy, we can help with that. And I'm also joined by my colleague from TI, Nathan Donaldson, who's one of our economic analysts and leading the data team who works on the Apply project. So welcome, Nathan.
Thanks, Michael. Pleasure to be here. Hello, everyone.
Thanks, Nathan. And then in addition, we have Marianne Savoni, who's Associate Director of Strategy and Market Intelligence at IRU. And Marianne, would you like to introduce yourself? And for those people that don't know IRU yet, introduce the organization as well?
Yeah, sure. So good afternoon to all of you. Briefly, IRU is the World Road Transport Organization. So in fact, we represent road transport sector worldwide. And I have to say that today we count more than 180 members and partners, and we are present in more than 80 countries, globally speaking. In fact, we count a large diversity of members that can be national road transport associations, but also large logistic companies, service providers, and shippers. And what we deliver exactly as IRU, first, of course, we advocate. We advocate at regional, notably at an European level, but also at global levels, at the UN, notably. We manage, we develop solutions also to facilitate the trade and transport, globally speaking. And this is also why I'm here today, is we develop intelligence expertise on decarbonization, on driver shortage, on digitalization. So yeah, in few words, this is what IRU is doing.
Thanks, Marianne. That's very helpful. And before I introduce Thomas and give him the chance to introduce Supply, I'll just read out our little disclaimer here as well. So we remind you that all discussions and statements made by participants on commercially or strategically sensitive information may fall within the scope of competition law, and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussions, including during breaks. Okay, and our last panelist is Thomas Leroux. That's the Chief Executive Officer of Upply and been on every one of these webinars over the last few years. So most of you, I'm sure, already know him. But if you'd like to introduce Upply and yourself, Thomas, that'd be great.
Hello, Michael, and good afternoon to all. Yes, Upply is a tech company dedicated to supply chain and more specifically to transport industry. We are providing different services to shippers, carriers, freight forwarders, including a marketplace to exchange and to find freight transportation, especially in the road transportation. But we have also CO2 estimators. We have dashboarding to manage and to organize the transport of a dedicated company. And today, what we are doing, we are gathering all the data that we have on shipments to provide then insights that we will see on the following slides.
Thanks, Thomas. Yes, fantastic. And the next slide actually is on the methodology. So a bit of background on that for those people that aren't familiar with Upply data as well, please.
Yeah, so exactly here the idea is to take this data that is what we call transactional data, meaning that real shipments happen at a specific price on a specific characteristics. And we gather all this data from shippers and freight forwarders directly being connected to their transport management system or directly seeing it on the freight marketplace of Upply. These are the same data that we use on, the same type of data that we have quarter over quarter. Just to summarize it, we're looking today at FTL full truckload data on general cargo. We will have spot and contractual prices. The fuel will be included in most of the data, and you will see also data on the fuel. You will see data on fuel, on HVO, on different type of carburation. So it's something new that we will discuss today. So yeah, this is the summary. We do have additional data at Upply, like reefer, bulk, or other type of transportation. We focus here on FTL, general cargo, what is, from our point of view, the most representative of the road transportation network in Europe.
Thanks, Thomas. Yes, that's great. So we'll move on now to the European road freight benchmark, which is our overall European picture as to what's happening with rates. And as you can see, compared to recent years, we've got a relatively stable period of rate development. But Nathan, could you take us through the trend and what's changed this quarter?
Yeah, sure. Thank you, Michael. So I would agree. We've got a more stable environment and generally rates remain elevated. So if we look at the actual figures that we're seeing here, the contract index is flat. So that's no change. It's at 127.2 index points, but that is down slightly. So that's down 2.1 points year on year. We'll look over on the spot market now. The spot rates have had a big 4.4 point fall quarter on quarter. And that's down 6.1 points year on year. And that takes it down to its lowest level since Q1 2022. Considering the gap between the two indexes and the two markets in Europe, that gap's widened. That's widened quite considerably, actually. So it's from 0.4 points last quarter. It's now 4.8 points. So the spot's sitting 4.8 points below the contract index. Now, this means that the spot prices are dropping considerably in some places. We're seeing that some markets are seeing a spot price below the contract price, but this doesn't mean that average spot prices in Europe are below contract prices. This is the price relative to Q1 2017. But this is largely to falling demand side pressure and falling prices as a result, similar that we're seeing in other logistics markets at the moment. If you're aware, you might see falling prices in sea markets as well. So if we consider the demand, generally it's a similar picture across Europe. So consumption demand is the pressure for that is stable. So we saw towards, when we're looking in 2022, there was a large inflation and a big drop-offs in the demand pressure there from consumers. That remains stable. Consumers just have less money to spend, demanding a lower volume of goods. But we're seeing that that's not having an active effect on the short-term pressure and the short-term prices in the road freight market. Now, if we do look at what is causing these drops in spot prices, This is more the production side of things in Europe at the moment. So if we look at some indicators here, we have Euro area PMI. So that's dropped to 45.0 in September 2024. Anything below 50 suggests contraction. So it means that we're seeing contracting manufacturing and industrial sectors across Europe. Significantly, Germany has dropped to 40.6 in September, and that's its lowest figure for a year. So we've got multiple factors that are causing this effect on industries across the continent. Simply, as we mentioned before, the inflation has resulted in consumers that have lower real terms incomes, they're demanding a lower volume of goods. And we're seeing this kind of lagged effect of that now, where we now have lower new order volumes, lower pressure for industry to meet the demands of consumers. And that's not just in Europe, that's across the world. And at the same time, we've got European producers that have faced higher cost bases, producer prices up significantly. Yeah, producer prices at 124.2 points. Compare that to 2020 level, that's up 35.3 points. So we have European producers that are less competitive, they're facing higher costs, and that's in a weakened global demand environment. And we're seeing lower demand for output, so reduced output demand for products to the rest of Europe, but we're also seeing reduced demand for intermediate goods towards Europe's manufacturing centres. So generally, it's providing a drop in pressure, short-term demand. It's freeing up capacity across Europe. It's reducing the level of competitiveness. So it's increasing the supply side competitiveness as supply is freed up in Europe, and we're seeing lower rates. Just quickly to touch on the supply side, which my colleagues will go into a bit more. The rates remain, the costs remain well above their 2020 level. Pick out a few numbers here. We see tyres up 20.9% versus 2021. So that's the cost of tyres. Maintenance up 21.9%. So a higher elevated cost base. So we see that the prices remain much higher than their 2021 level. If we look at the big picture, we expect this to remain elevated, but we are seeing poor manufacturing performance, poor new order performance, which could continue to bring that spot price down. However, consumption remains quite stable, and it's really dependent on if we see that European economic recovery that could quickly remove this extra capacity and cause some more stable or even some price increases. But for the moment, we're heading downwards with reduced demand and increased capacity.
Yeah, thanks, Nathan. So I mean, it's interesting. We were, of course, talking probably this time last year, quite optimistically about the second half of 2024 in terms of demand, expecting it to pick up. We haven't really seen that recovery come in just yet. And I think the future is largely based around, when will that uptick come into play, really. So we have our poll, as usual here, which I'll just launch now, which is asking you, how will European road freight rates change over the next 3 months? And we'd like you please to participate in that and give your view as to how you expect rates to develop. And then we will try and give our quick take on that once we've got the results in. There we go. I can see we've already had a couple of hundred of you participate in that, so thank you. Coming through quickly now. Yeah, so I think it looks like there's a fairly mixed view about rate development, which I think probably speaks to the fact we've seen a sort of relatively stable few quarters. It's not exactly clear which direction it will head in, but that's a good number of you participating now. So I will end the poll and share it with you all so you can see exactly the results there. And I think you can see generally grouped around the sort of remain flat or slight increase or decrease there. But Thomas, do you have an immediate take on that?
Immediate one, it's quite difficult to say, but we can. I think it's the first time that we have a pool that is quite well balanced in the middle of it will remain flat. I can agree that the fact that it will be flat certainly, but we might see a certain increase in the quarter to come, mainly due to the fact that costs are high, very high, and continue to increase. So this is something to take into account for sure, because the carriers won't be able to bear the cost without passing it to the shipper side. But we will see that in the following of the webinar and then in the report.
Yes, I think that's right. There's a fair bit of uncertainty now, but basically things remaining fairly stable. Okay, let's move on to our next slide then. So here we're looking at some of the supply side issues which Marianne's going to take us through, starting with diesel.
Yeah. So I will maybe start with one figure that you can see on the screen, which is the average diesel price at pump that we can see for Q3, which is €1 57 per liter. And in fact, it's the situation is quite very volatile. What we have observed is that diesel prices increased between mid-June and early July, which was notably driven by the rising crude oil prices, but then there were downward trajectory until the end of the quarter. And however, in October, food prices started to rise again, which was notably linked with the escalation of the conflict, of course, in the Middle East, and which is raising the possibility of oil supply disruptions. And I just wanted to mention something specifically on what we can say on the crude oil price trends specifically, because of the situation in Middle East. And in fact, the Brent price rose to $79 per barrel in October, so which was 11% up from a week earlier. But however, we see that prices started to fall again after 15 October. So there is, I mean, a very high volatility, and the keyword for all prices seems to be very high uncertainty. Now, for the first time, and Thomas just mentioned it before, I will give you some overview on some additional energy or additional fuels that we are monitoring in IRU in terms of weekly prices, notably on CNG and HVO, because it is giving you a good, I think, understanding of what is happening also on these different fuels. As you know, diesel powertrains remain currently of course, by far the main fuel. 99% of the trucks in the EU are running with diesel powertrains. But however, we can see the increasing traction of the alternative powertrains. And we can say, if we take the figure of last year, 56,000 vehicles used alternative fuel. So this is a huge increase, which is a 100% increase versus 2022. And CNG and electrical vehicles are pushing really this increase. So for CNG trucks, and really the increase that we see in terms of CNG trucks is really associated with the implementation of the Eurovignet directive. I will mention a little bit some more detailed information on the CO2 tolling. But clearly, this increase of CNG trucks is really linked with this directive, notably in countries like Germany and Austria that are applying a lower toll rate for CNG vehicles. On prices specifically, CNG and LNG prices are influenced by raw material costs, distribution, and taxes, which is showing a very high disparity depending on the countries. To give you an example, CNG average price go from 1.29 euro per liter in Spain, which is the lowest level, going until 2.6 euro per liter in Sweden, which is the highest level. When it comes to HVO, price are between 0.10 euro per liter and 0.50 euro per liter more expensive than diesel, except in Italy, where you have cheaper, where it is cheaper due to government subsidies that we can see. So I will stop here on the fuel prices. I invite you to go to check IRU website, because we are really tracking this evolution on a weekly basis, and you can really get the last information going to the website. Back to you, Michael.
Thanks, Marianne. Yes, really interesting data, even in the report, actually, just on the different fuel types there. So,
Exactly.
yeah, it's great. But the next slide here is really looking at developments on the tolls. I mean, we've covered tolls a lot over the last few quarters, but we see ongoing developments there. So, can you take us through the latest on that, Marianne?
Yeah, absolutely. So maybe just to start with this message, I always say that because it is just to explain why you have some disparities in terms of implementation. You see on the map that you have different agendas and different timing of implementation. And the main reason behind that is that the Eurovignet directive is based on digital distance measure for toll calculation, and not all the member states are using such form of tolling, notably the gated distance tolling, such as in France, or time-based tolling or vignette, which is the case of the Netherlands. So the map that you can see is showing the implementation agenda as we know as of today. You have the last update just below on the slide specifically for an Euro 6 Class 1 truck in terms of cost increase that it can represent. We update this map each time where there is a modification. So you can also follow the updated version of the map going to our website. So in light blue, you can find that the 4 countries that have already implemented the CO2 toll taxation are Germany, Austria, Hungary, and Czech Republic. But the 3 new countries coming are Sweden, Denmark, and the Netherlands. And I just have shared an implementation plan a few weeks ago. And you can see that for these 3 countries, starting from January 25, trucks with a gross combined weight greater than 12 tons will be subject to the new CO2 components, while the trucks of 3.5 tons and above will be concerned only starting from 2027. Something that I want to mention, because I think you heard a lot about it, is the implementation of an eco-tax in Alsace, in France, that could be similar to Eurovignette and that was voted on the 21st of October. And this is leading, we see in terms of timeline, a potential deployment in 2027. And it will target, in particular, the A35 highway, which is largely used to avoid the LKW mode in Germany. For other highways, the implementation of Eurovignette directive will depend on the concessions renewal. Just to remind you, because we mentioned that I think in the previous webinars, but you see that a lot of members still need to apply or to implement the tolling, and the European Commission have sent in May this year a kind of reminder or formal notice to move on the implementation of the directive. So we will see some new countries coming up in the next months. Back to you, Michael.
Fantastic. Thanks, Marianne. Yeah, so some progress there then for particularly for those new plans from Sweden, Denmark, and the Netherlands. And the next slide is talking about another issue that we're trying to push through in the road freight market on tachographs and updating those. And progress seems a little slow on this, Marianne, but be interesting to get your take on it.
Yeah, I would try to be very simple on this topic. So it's part of the mobility package 1. Since August 23, so last year, transport operators have the obligation to retrofit all vehicles registered in the EU and intended for cross-border operations with the smart tachograph version 2, so the G2V2 version. And depending on the current type of tachograph installed in the vehicle, there are 2 deadlines that are applicable. The first one is to replace, the first deadline is to replace the analog and digital tachograph, G1, as we say, by the end of this year, so by 31st December. But there is a second deadline, which is to replace the first generation of the smart tachograph, G2V1. The deadline is August next year, 25. So as you mentioned, indeed, Michael, the retrofit process is very long. There was notably due to a massive delay in the supply of the G2V2 devices. And you can see what you can see on the slide. We have done a survey to transport operators, and you can see that in June, the share of vehicles retrofitted has increased to 6% versus, have reached 6% of share versus March. But there are still around 60% of G1 vehicles and 33% of G2V1 vehicles to be retrofitted. So indeed, it's going to take some time. But the thing is that when you see that, it means that even if the retrofitting pace strongly accelerates, let's take this assumption compared to what we observe until now, there is going to be a significant share of vehicles with G1 devices that are going to run in violation of the law because they are equipped with tachographs that fall under the first deadline I was mentioning. So as a result, we need to monitor the situation because it can have an impact on market capacity.
Yes. Okay. So some challenges there then. All right. Well, we'll move on to our first lane-specific rates chart now then. So this one's looking at Madrid to Paris and the return leg as well. And Thomas, you're going to take us through this one.
Yeah, we will start with this one and to see really the deflection, the difference between the inbound and outbound from Madrid to Paris or Paris to Madrid, while previously, before COVID, let's say, the prices were very close one to the other. Now we clearly have a decrease in prices for the past quarters when the trucks going from Madrid to Paris versus Paris to Madrid there is many explanation to that, and the main one, and the one that we are giving over the past webinar, is still active here. When we have a look at the global wealth economy of these two countries, we have Spain, that is still in very good shape in the Q3 2024 when we are looking at the national statistics, while France has a quite quarter, Q3 plus 0.4%. Spain is at plus 0.8 or 9, so much higher. But France, due to the Olympic Games, also has quite good traction over the quarter. But when we go into detail, France has is fighting inflation quite good, but the recovery in the retail sector remain very slow and disappointing, and the demand for goods from the top partners of France, that are Spain and Germany, and we'll see Germany just after, is quite weak, so that the demand of transportation is quite weak to go from Madrid to Paris in this case. And we see clearly that, so weak demand, we see that here clearly in decrease in prices. On the other way, from Paris to Madrid, we see kind of stagnation. We had an increase, quite sharp increase, while the industry in Spain is quite well. Also, we'll see that in the next slide. Here in the gray and black lanes, we can see it's come back to levels where we have spot and contractual that are not that far away, and that, from my opinion, or from our opinion globally, here will remain at this level. The decrease that we have seen in the red part from Madrid to Paris should stop also, because the costs, as we are saying, are very high. The cost of owning a truck, operating a truck, are very high and keep increasing. So here we start to reach a level where we don't see the rates going deeper down.
Yeah, so we've sort of adjusted to the higher volumes of Paris or Madrid to Paris, and Paris to Madrid, and then we've hit the floor really with the other direction there with costs. Okay, thank you very much, Thomas, and we'll move on now to the next lane, which is Germany, France, and I think Marianne, you're going to talk us through this one.
Yeah, so what we can say here on the head wall towards Lille, the spot prices, as you can see, fell. They fell by 5% quarter on quarter, and they are now down 6% year on year. The same dynamic is for the contract rates on the head wall, falling by 4% quarter on quarter and 4% on year. When you look at the backhaul towards Duisburg, spot prices fell following a 7% quarter-on-quarter drop and taking them down 6% year-on-year. And the contract rates to Duisburg are the only price that really rose. And you can see increasing 3% quarter-on-quarter, and it is up 0.5% year-on-year. So as you can see on the graph, this result is a significant convergence you see between the two markets. Spot prices on the backhaul are now 4% more expensive than the contract rates, which is down from 16% from the last quarter. So explanation behind the dynamic, Nathaniel gave you some big outlook at the beginning. This is what we really can say here. There is a falling industrial activity, which is the leading cause of the falling rates on both sides of this lane, and notably the low production of the transport equipment. And this is quite impacting the demand for road transport, notably for intermediate, capital, and finished goods. If you take the example of France, the output is falling by 7%. So industrial woes appear to be spreading across Europe, as this wider French manufacturing struggles to sustain any significant growth in this weakened global demand environment, and the PMI is really confirming that. So looking forward, the outlook for the road prices on this lane is further rate falls, as the closely intertwined production sector of France and Germany can continue to struggle because of the cost increase and because the demand is still low. And the consumption also is expected to remain stagnant. What we can say on the other side, that improved peak demand from the consumers following the lower inflation maybe could have some upward pressure at the end of really Q4 24. Thank you, Michael.
Thanks, Marianne. Yes. Okay, and again, this next one is also looking at Germany, actually. So we'll touch on some of those things around the German economy here too. But this is Poland, Germany, and Nathan's going to talk us through the trend here.
Yeah, thank you, Michael. So generally rates are rather flat on this across the board, really. So and that's just apart from Warsaw to Duisburg spot rate. And if we look at the actual price changes on this lane, if we look at the head haul towards Duisburg, we've got the spot price falling 5.9% quarter on quarter. So that's the big drop that we're seeing there. However, they remain up 1.3% year on year. If we look at contract rates, they fell just 0.5% towards Duisburg. Now, the result of this, if we look on the head haul, is the two markets converging somewhat, and it's quite considerable change from last quarter, actually, because the gap between spot and contract is now 4.9% compared to 10.9% last quarter. So quite a considerable convergence there. If we look at the back haul, this is towards Warsaw. If the spot prices fell just 0.3% quarter on quarter, but they do remain up 10.3% year on year. And the contract rose just slightly. So now, considering the effect here, that the big thing that we're seeing and the big fall that we're seeing in that 5.9% is German manufacturing is leading this drop. We saw a 5% fall quarter on quarter in overall output, and that's a big change from last quarter where we saw just not minus 0.2%. This was driven largely by a 7% fall and a 7.3% fall in the production of capital and durable goods, respectively. Rates into Poland are more stable. This is mainly because Poland has a really strong consumption at the moment. Recent wealth growth over the previous few years has protected the incomes of Polish consumers, and as a result, we're seeing a very stable demand from Polish sectors. However, there is a knock-on effect of the German manufacturing, and that is causing a fall in the demand of Polish output. So Polish output actually fell for the 28th consecutive month, and that's a result of the knock-on effects from German industry. However, Polish GDP grew plus 4% in quarter two, and that was the largest growth in the euro area. So really strong from Poland, but it can't really escape the knock-on effects of the German industry. If we look at the outlook of this lane, generally, like I say, the demand to Poland is set to remain stable from a consumer side, but the industrial numbers look like they will continue to fall as we go through into the year, into next year. So if we look at new orders, German new orders are up 3%. However, this is largely due to an increase in demand from the automotive sector, which saw a big fall towards the start of the year, remains very low. So if we look at the other sectors, we see that durable goods, the orders for new durable goods is down 9.4%, and consumer goods minus 5.9%. So it looks like we're heading into a stage where production for the German industry is going to stay low. It's going to demand low levels of road freight, and there's going to be low levels of demand on the sector. Free capacity, which should keep rates low and stable for the time being, and that's the outlook on this lane.
Okay, thanks you for that, Nathan. So we'll move on now to some of our more specific lanes this quarter, and actually this one is looking at port import exports, and I can see we've had a question asking about the effect of port volumes on rates and whether we can see that. So I think Marianne's going to talk us through this and see if she can shed any light on that for us.
Yeah, as you said, Michael, it is the first time that we give you this overview. And here we consider the ports of Rotterdam and Antwerp. So on export lanes from the European cities towards Rotterdam and Antwerp, contract rates have slightly increased, as you can see, by close to 1 point to reach 135 points. And the spot rates on this leg have been declining since Q4 last year. And compared to the same period last year, this is a drop of 9 points in total. And contract rates are 22 points higher than the spot rates. On the import lanes from the ports toward the cities, the contract rates index stood up 2 points versus Q2 24. And finally, on the spot rates on this leg experience an increase, as you can see, of a similar magnitude, increasing by close to 3 index points. Contract rates are 6% points higher than the spot rates. So the main explanations here are the high cost environment in the Netherlands, but also in Belgium. Of course, in the case of the Netherlands, you have an average annual rate of change in Q3 for insurance that was very high in terms of increase, which is about 80% increase. For tires, the average increase was 8%, and for maintenance and repair, the average increase was 3%. And in Belgium, you can have approximately the same increase, which is a little bit less significant, but it is quite already a good increase in change. And notably, if I take again the example of maintenance and repair, it was really cost up 4%, and tire prices increased by 1%. If you want to look ahead, and notably for next year, we can say that the private consumption and the stronger investment that are supported by the improved financial conditions are expected to boost the GDP growth to around 1.4% according to the European Commission. And as private consumption grows, we can expect to observe a modest growth in the European import rates. And what we can so expect that there will be more upward pressure as a result on the freight rates on export lanes later in the business cycle as the manufacturing is going to or expected to recover. Thank you, Michael.
Thanks. So yes, we see a little uptick on the import side, and perhaps you'd expect more as the economy improves and demand improves as well. Okay, so next thing we're looking at is looking at GB imports. So Nathan, would you take us through this one, please?
Yeah, thanks, Michael. So this graph shows an indexed figure for GB imports and French exports. So all the figures available that cover that category. Generally, what we're seeing is it's a varied situation, but we're seeing an increase in the contract rate and a fall in the spot rate. So we have, again, similar story that we've seen across the continent where we've got that fall in pressure on the spot market if we look into the short term, but we have that increased and that remained that constant pressure on the contract market that we've seen in the other markets as well. So the big thing here is that if we look at the actual demand and the activity from the UK, the consumption remains quite stable. So we have the contract and the long-term contracts remain quite stable from the consumer side. The UK consumption is actually increased 1% in Q3. So some steady increases there. And a large firm, of course, we know Tesco saw a 2.9% increase in like-for-like sales. So that's effectively a 2.9% increase in volume. However, manufacturing output remains poor. So we consider that both in the UK and in France. And we've already discussed the situation in France. We look at UK, some trade numbers become really useful here if we consider its trading relationship with Europe following Brexit. So if we look at the imports, they're down 1.5 billion, so that's 3%. And exports down 3.4 billion, so 10.8%. So the effect is that we're continuing to see fall in demand, especially as we've mentioned throughout this webinar. We've got a weaker international demand environment. So this is causing reduced volumes on this lane. It's causing, especially in the short term, we're now seeing that it's freeing up capacity. It's reducing the demand pressure on the lane. It's pulling down the spot. Of course, with this lane, we do have the unique situation of Brexit, which, even though it feels like it was a long time ago, we still seeing the effects. So the big thing here is the checks on meat, dairy and plant products has been delayed. So that's for the 7th time now. It's now been pushed back to July 1st, 2025. Now, this has actually cause less pressure in terms of delays, in terms of extra administration and extra costs. How it does keep a level of uncertainty there, which isn't really helping prices. But it does mean that it facilitated this price fall, which could have been a very different situation had we seen increased checks on that lane. So that is like, if we look into the outlook, we look into next year, we could still see some increased delays, increased costs, as we see that for increased checks are coming in. And that's particularly going to affect it heading in. So that's going to be GB imports. However, EU checks have been in place since 2021. So there's an imbalance there. So we already have that higher price. We already have that delays, and we're thinking about GB exports. So it's a slight imbalance there. It's a different situation. The uncertainty remains, but we have seen reduced activity and a weak demand environment as we see across the continent. And then with the delayed checks, we see that has not added pressure. It's allowed that fall. But as we look into the future, there's continued weak demand environment, but there's a possibility for further increases in costs and delays on this lane.
Thanks, Nathan. As and when that may eventually happen. Okay. All right. And our last rate slide today is on a domestic index, actually. It's time for Spain. Thomas is going to talk us through this one.
Yeah, we already talked about Spain with the view of France, Spain, so I will be quite quick on this one. But what we can see here is that, so first, just a comment on that because we had questions. This is an index view where you have the base that is 100 base in January 2017. Be careful, you have some graphs with 100 base like that, where you have the evolution of rates that is showing. This is usually when you have a basket of different goods, different origin and destinations. Here we are in Spain with different origin and destination and an average basket of that. While sometimes you have the euro directly, for instance, from France to Spain, it was from Madrid to Paris, and you have the direct costs of a full truckload between this origin destination. Just a small comment on that because we had a lot of questions. Here on the Spain, what we see is that the sharp increase that we have seen after the COVID with the increase of rates is stable right now. So it's this high increase of rates, and compared to the other countries that we have seen in Europe, these rates are almost flat. For sure, the spot rates are most volatile and most subject to seasonality for agricultural goods, for instance. But when we're looking at the average over quarter, this is quite stable. Why? Because we have still a strong demand in Spain. I will only use two figures because we are already talking about that. But the quarterly growth in Spain was 0.9 in the Q1, 0.8 in Q2, and the overall growth is expected to be at 3.1% by the National Institute this year. So this is for sure very high, while other countries in Europe are barely at 1%. And if we're looking at the Spanish manufacturing sector, they hit a top record in terms of PMI indicator over the past quarter. And this is we see that directly in the graph where we have sharp increase of rates that now are stable but keep to stay at this level, while other countries in France or Germany are decreasing and reaching a lower level of freight rates.
So Spain actually provides an interesting case study of what happens in a market in Europe with elevated demand in terms of rates, even in the cost environment we're in at the moment. So quite a contrast with many other markets, as you say. All right. Well, that brings us to the end of the presentation today. So thanks to panelists for your contributions and your insights. And we'll now move on to the Q&A session. And so please do answer or ask any other questions that you may have in the Q&A app. I can see that we've already had over 20 questions through the actual presentation. So we've got quite a lot to work with already, although some of them have already been answered. I think, Thomas, you sort of dealt with the question around why sometimes in indexes spot rates might look higher than contract rates. So I think that's just a matter of the indexing, really. And you can see in most of the sort of absolute rates in euro terms that actually most of the time we do see spot above contract. So I was going to ask that, but I think we've dealt with that one. I think then it might be nice just to ask some of these questions. We had a few on the outlook for Q1 2025 or for the next quarters. Dealt with that a little bit when we did the poll, but Thomas, do you have anything else you'd like to add? I can see you put your hand up to answer that particular question.
Yes, here we are entering a quite gray area where the global seasonality in road freight in Europe is that over the Q4, end of Q2, Q3, Q4, we should see an increase of rates, kind of peak season just before the Christmas part, and everything. While the Q1 is the down season in Europe. So I will not give figures for Q1, especially Q1 2025, for instance, but more looking globally at today in Europe, we have a demand that is quite weak, that is not expected to increase sharply in 2025 if we're looking at the BCE or the General Institute forecast. But we are reaching a level where the number of carriers, companies that are going bankrupt is high, very high in Europe, especially in certain countries. It shows directly that costs are high and higher again and again. Prices hit a certain high over the past quarter, now are decreasing a bit. I think we are reaching a limit where you cannot go further down. Maybe on certain corridor because we have a very imbalanced offer and demand, but globally, rates should be stable at least over the quarters. Maybe they will decrease at the Q1 2025 because this is a kind of seasonality, but we should see rates that are now stable and following the increase of rates, of the increase of costs, while if the demand is going up again, rates mechanically should increase to reflect that.
Yes, and I might just add one other thing to that that might possibly change the floor we're talking about in terms of rates and the relationship with costs is that hesitate to mention the US election, but obviously that has happened, and we now have the prospect of Trump's policies on energy and oil coming to the fore. And I did read this morning that some analysts predict, prices for oil could go down to $50 a barrel, maybe even some as low as $40 a barrel. And obviously, if that were to happen in the years ahead, we'd see that cost base drop, and therefore that floor would drop versus our expectations at the moment. But I guess that's a fair way down the line.
No, but you're right that the energy will be key also, because the view that I explained just right now is without taking into account for sure the increase of the additional cost, additional surcharge linked to CO2 tooling, linked to the fact that more and more shippers want to have electrical vehicle or HVO vehicles, and this has an additional cost for sure that cannot be borne by carriers only. This is not possible given their P&L actually right now. This won't be the case.
Yeah, and I suppose that takes us on to another question I can see you've raised your hand for, Thomas, which is about shipping companies having enough profitability to decrease the price they're charging while...
yeah, that was a question from Hugo. The question is, if I stated one again, is what type of shipping companies is having enough profitability to decrease the price while cost will continue to increase? When we are looking at the financial publication of big carriers, freight forwarders, they still have some space for sure, and this is the business. They still make profits. But honestly, right now, with the rates that are decreasing, the costs that are increasing, I don't know. I think the room for decreasing of price at this time is very low.
Yeah, margins are very thin for carriers, that's for sure. Okay, we maybe come to a couple of questions, perhaps for you, Marianne, if that's all right, which we've got a few on the sort of regulation side. So there's just one here, which is just asking for a bit of an explainer about some of the differences between those tachographs types. Would you be happy just to give a brief overview of those?
Yeah, very simply, it is just a question of generations of tachograph. And in fact, the last version is really supposed to answer more specifically the multi-package implementation and enforcement, notably on the timing and driving resting time. So that's why you have this obligation to then comply with the last regulation. This is corresponding to this last version that I was mentioning during the webinar. To make it very simple. And I think there was also a question still on the tachograph that I can, if you want, that I can also
yes, around sanctions.
On the sanctions. Yeah. In fact, it's difficult to it's a question of member states, in fact, decision. So for sure, economic sanction, but then in terms of, notably in terms of immobilization of the vehicle, it depends on the decision of the situation, decision of the country. So you can have, for example, an economical sanction in one country, but then you can have an immobilization of the vehicle in the country of residence. for example. So it will depend on the different use cases, but the decision is coming from the member states.
Okay, thank you. Yes, and just for anyone who can't see that question, it's just about what would be the sanctions if you fail to meet the deadline to move up to the next
Yeah, exactly. So
generation.
yeah.
Yeah.
Penalties and yeah, exactly.
Yeah, thank you. Okay. Right. Let's see.
If I can, Michael, I've seen one question at the very beginning, I think. That do you see reefer developments type different versus general cargo? In short, do we see different type of evolution of prices of rates between cargo and reefer trucks? For sure. I mean, here once again, the idea is to take the most representative truck, that is general cargo. But then when you're entering the reefer parts, the temperature control, let's say, because we have different type of temperature control, then it depends to the seasonality of the product that you are shipping. If you're looking at Spain, Spain to France, or France to Spain, or France to Italy, or certain countries like that, you will have a seasonality that can be very local, let's say. So the reefer part is quite tricky. We have data on that on Upply, and we can work and help on this topic, but it's very difficult to have an European index on the reefer part.
Yeah. Thanks, Thomas. And I think we've had a couple of questions on the relationship between fuel and rates. And Nathan, I know you've done some research on that relationship, so I don't know if you'd like to offer a view as to how you see that relationship mapping.
Yeah, sure. Generally, we do see them tracking really closely. It's a big contributor to rates. I think I saw a question around the demand for fuel and the effect on the fuel prices. I think that's hard to answer, especially at the moment. There's so many other more volatile factors that are going to send fuel in a direction, and they will control fuel rather than the demand of fuel. I think if we're in a quieter environment, then we could consider the demand for fuel and how that might affect things. But I think it's really going to be based on the geopolitical environment, the effect on fuel. But we can absolutely say that rates will largely it will affect the cost base. So overwhelmingly, the effect of short-term demand is going to push rates in either direction, but there's always going to be that effect of the cost base. And as Thomas has mentioned, there's that limit to the cost base. So as we see fuels rise, it's going to limit that lower level that some of the rates that we can see can drop down to. But I say it's a fine balance, really. It's constantly affecting the cost base. It's going to affect more. You're going to see that in the contract markets. We see a stable contract market. The costs are going to affect that really clearly. You're going to see that change. Looking at the spot market, that's more sensitive to demand. And whilst the costs will have an effect there, at the moment we're seeing demand being in a stronger factor for the spot market, but a good indicator for the contract market, as with all of the costs.
Thanks, Nathan. And one other interesting question on the regulatory side, really. I mean, relatively recently we had the decision against driver posting and the changes in the regulations there. So we have a question asking, how are the new mobility package changes trucks from Eastern Europe not to return every 2 months home going to impact the capacity and prices for road trips from Western to Eastern Europe? So I don't know, Marianne, if you have a view on that.
Yeah, I was going to take the floor to mention just before I answer this point, because the answer is not very easy. We don't see a major impact in terms of really capacity and prices, but there is something that maybe you heard that happened beginning of the month. In fact, the court has cancelled the mandatory return of vehicle within the 8 days because there was a lot of member states that have requested to the court the possibility to cancel this provision, and it has been validated. Maybe I think you saw it at the beginning of the month. So it will then and the rest of the provisions are going to be maintained. So this is something that's which is important, I think, notably for the cross-trade and cabotage. But we are going to monitor this situation. But yeah, in terms really of the impact of the changes on multi-package, we don't see very major, I would say, impact on the capacity as of today.
Brilliant. All right. Well, thank you very much, Marianne, and thank you very much to all of our participants and attendees today. So that draws our session to a close today. But if you want to carry on the conversation, please do use the details on your screen now to contact us. As I said at the start, we'll be in touch with the report and presentation and recording, and to answer any other questions that may be outstanding as well. So we'll be happy to carry on the conversation. But thank you all for joining us, and thank you to Marianne, to Thomas, and Nathan for their views and insight today. And we'll see you next time. Bye-bye.